Gold suffered its biggest weekly drop since the beginning of March this week, while silver fell to a new 2012 low. Friday's PM London gold fix was $1,565.50, a fall of 3.8% on last week. Friday's silver fix, meanwhile, was $26.81, a 6.5% weekly loss. Things started quietly for gold on Monday after pro-bailout parties won a majority in Sunday's Greek elections. On Tuesday, however, as Federal Reserve policymakers began their two-day meeting, gold began to fall. It continued its fall after the Fed announced its latest monetary policy decisions on Wednesday, with the drop accelerating as the US opened the following day. At its meeting this week, the Fed opted not to launch another round of quantitative easing, a decision which seemed to disappoint some in the market, although it was hardly unexpected. What the Fed did do was extend Operation Twist, which involves the Fed selling shorter-dated Treasury bonds and buying longer-dated ones. The aim of Operation Twist is to put downward pressure on longer-term interest rates. While he did not announce more quantitative easing, Fed Chairman Ben Bernanke did argue in his press conference that previous rounds of QE have been beneficial and that the policy remains a tool that can provide support to the economy. Bernanke added that QE2, the second round of quantitative easing, ended an incipient deflation problem when it was launched in 2010. Gold's fall this week invites comparisons with 2008. That year saw 11 weeks in which gold fell by 4% or more. It was also, of course, the year that saw the fall of Lehman Brothers and AIG, as well as dramatic falls on world stock markets. It is, of course, too early to say whether gold's current weakness is an advance warning of similar threats, but it does look like we are in for another volatile period, which is likely to be exacerbated by ongoing policy uncertainty. The big test for gold is whether it can remain above the 1520s range that provided support last month. Here in Europe, Spanish 10-year bond yields breached 7.2% this week, while Spain had to pay more than 5% at an auction of 12-month bills, compared to less than 3% last month. Next week sees the latest Euro summit, at which policymakers will attempt to overcome their enormous differences and craft a convincing solution to the debt crisis. Call me cynical, but I suspect the only question to consider is how quickly markets will manage to register their inevitable disappointment. To keep up with the latest in gold and silver, visit goldnews.bullionvault.com.